All right, let's dive right in. Today we're going to break down a really popular Forex strategy known as the London Breakout. It's all about capitalizing on one of the most powerful, and believe it or not, one of the most predictable moments of the entire trading day.
You know, a lot of people see the 24-hour Forex market as just chaos, right? Constant, unpredictable noise. But the truth is, it has a rhythm, it has a pulse. And our job today is to figure out how to trade that pulse, specifically that one moment when the market really wakes up and shows its cards.
So, what's the big secret here? Well, it all comes down to a really simple observation about how the market's personality shifts throughout the day. You can really think of it as a tale of two sessions. One is kind of quiet and sleepy, and the other, it's explosive.
Okay, so here's the core idea in a nutshell. During what's called the Asian session, things are usually pretty calm. The market is just consolidating, kind of coiling up like a compressed spring. But then, London opens its doors, and bam, a massive wave of money floods the market. That sudden burst of volume is the force that can send the price flying out of that quiet range. And that, my friends, is the move we are here to catch.
All right, sounds good, right? But before we can actually put this plan into action, we've got to have the right tools for the job. And look, we're not talking about some magic holy grail indicator here. It's just a simple, specific toolkit that'll help us see what's happening with absolute clarity.
So, what's in the box? First up, we're going to focus on the major currency pairs. You know, the ones with a ton of action, like the euro versus the dollar or the British pound. We'll be looking at the 1-hour chart, which is just perfect for smoothing out all that crazy 5-minute noise. Then we have our trend filter, the 50 EMA. Think of the 50 exponential moving average as our compass. It just tells us the general direction the market is heading. And lastly, we've got Bollinger Bands. These are great for spotting when the market gets really quiet and tight, what traders call a squeeze, which, you guessed it, often happens right before a big breakout.
Okay, tools are ready. Let's get to the actual game plan. This is where we take that simple idea and turn it into a step-by-step, repeatable process.
First things first, you've got to define your battlefield. And for us, that's something called the Asian range. It's super simple. You just find the highest high and the lowest low the price hit during those quiet morning hours. We draw a box around it and boom, that's our launch pad.
Now here's the really clever part. We are not trying to predict or guess which way it's going to go. No way. Instead, we set traps. We place an order to buy a little bit above the box and another order to sell a little bit below the box. But, and this is the key, we have a filter. We only let the trade trigger if it's going in the same direction as our trend compass, that 50 EMA. So if the price breaks to the upside, we only take that trade if the overall trend is already up. It's our final check.
And this is so important because it shows you this is a time-based strategy. We are only interested in that first powerful surge of momentum right as London is waking up. If nothing has happened within those first 3 hours, the opportunity is probably gone. You just cancel all your orders, shut it down, and wait for tomorrow. No chasing the market.
Okay, so you're in a trade. How do you get out? Well, this part is beautiful because it takes all the guesswork and emotion out of it. Your exits are automatically calculated based on the size of that Asian range box. Your take profit target, 2 times the height of the box, and your stop loss, your safety net, just half the height of the box. This setup automatically gives you a fantastic risk-to-reward ratio, which is honestly essential for long-term profitable trading.
Let's put some real numbers on this to make it clear. A pip is just the tiny unit of price change in Forex. So, let's say our Asian range box is 40 pips tall. That means our profit target is automatically set 80 pips away. And our stop loss, it's just 20 pips away. Now just stop and think about that for a second. You are risking 20 pips to potentially make 80 pips. That lopsided math is the engine that makes this entire strategy work.
All right, let's talk about maybe the most important part of any trading strategy, playing defense. It's all about how you protect your money. You know the saying, offense wins games, but defense wins championships? It is exactly the same in trading.
And here is the golden rule, the non-negotiable. You can't break this one rule. Never, ever risk more than 1% of your entire account on a single trade. I don't care how perfect the setup looks. This one rule is what ensures that a losing streak, and trust me, you will have them, doesn't wipe you out. This is the bedrock of survival.
Knowing when not to trade is just as crucial as knowing when to trade. So here are your red flags. Is there a huge news event coming out, like an interest rate decision? Yeah, you stay on the sidelines. The market can get completely unpredictable. What if the Asian range is way too big? Your stop loss would be huge, so you pass.
What if it's super tight? There might not be enough juice in the market for a follow-through. Remember, sometimes the most profitable decision you can make is to do nothing at all.
Okay, so we've got all these rules, the entries, the exits, the risk management. The big question is, does this thing actually work? Let's do a little reality check.
Okay, I need to be absolutely crystal clear about this. You are not going to win every trade, not even close. In fact, you should be fully prepared to lose on almost half of your trades. A realistic win rate for this is around 55%. This is not a magic crystal ball. It's a game of probabilities, and the first step is managing your own expectations. So if you lose so often, how do you make money? Well, the secret, the whole key to profitability, is right here. It's because your wins are designed to be much bigger than your losses. Remember that math we did? You're aiming to win at least twice what you risk. That means a single winning trade can wipe out the losses from 2 other trades and still leave you ahead. That's the edge.
This leads us to a concept that professional traders live by. It's called positive expectancy. Let's just think of R as 1 unit of risk, say the $1 you're willing to lose on a trade. This number, 0.65R, means that over the long haul, over hundreds of trades, for every $1 you put at risk, you can expect, on average, to make about 65 cents back in profit. Now, it's not a get-rich-quick number, but it's solid proof that the math is on your side if, and this is a big if, you follow the plan perfectly every single time.
And that really brings us to the most important point of this entire breakdown, and it has nothing to do with charts or indicators. It's all about your mindset. Your job as a trader using this system is not to trade every single day. Your job is to wait patiently for the A-plus high-quality setups that check every single box. Patience isn't just a virtue here, it's a core component of the strategy.
So that's the bottom line, isn't it? We've just laid out a complete mechanical blueprint for trading. The rules are simple, the logic is sound. But here's the truth. The success or failure of this strategy has very little to do with the chart in front of you. It has everything to do with the discipline inside of you. So the real question isn't, does the blueprint work? The real question is, can you follow the blueprint?